Hey, good seeing you, David. Hey, I'm a little at a loss here, so I'll try
Hey,
to put
Pat
together.
Lavecchia, we're live here, brother. Good to have you join us, and we're going to catch you up as you join us. We're talking about risk and DeFi, and we're gathered together with a number of our great friends. Pat Lavecchia from Oasis Pro. We've got Daniel from Tokeny, who's joined us. We got David Wagner from Houlihan Lokey, and Eugenie from RE7, and great to have all of you guys with us. And I'm joined by Albert Berdellins, who runs AI for Inveniam, and Kevin Cutterback, who's our chief data scientist. And our discussion today is around risk and understanding risk in DeFi, modeling risk in DeFi. What is it? How do we think about that in comparison to risk, say, in the traditional fixed income world? How does that translate over? We're going to talk about all of these things. And with that, why don't we go around and have everybody introduce themselves, and maybe a minute about yourself and a minute about your firm and what you do. And Eugenie, I'm gonna turn it to you first as somebody who's on this podcast for the first time.
Yeah, thank you, Patrick, and great to be on your podcast. Good to meet everyone. As a quick intro myself, I come from the buy side, started in equity long short, then UBS, Deutsche, and eventually got into the crypto world in 2015, and it's been a long journey down the rabbit hole. Fast forward to today, I'm the founder of Re7 Capital, which is the firm I set up a few years ago. We specialize in DeFi investment strategies. We run a DeFi fixed income strategy and basically long-only strategy, as well as running some kind of blockchain vaults and protocol managing risk for some protocols.
Fantastic. What a pleasure to have you with us. Pat Lavecchia, buddy, great to see you. Thanks for joining us. Give us a little bit about yourself and Oasis Pro.
Great. Thank you, Pat. It's always a pleasure being on Inveniam's webcasts. They're very informative, and this is a great group you put together, and I appreciate being a part of it. Pat Lavecchia, I'm a investment banking for a long time. It seems like, eons ago now. In the blockchain space, I'm the CEO and chairman of Oasis Pro and Oasis Pro Markets. Oasis Pro Markets is a BD. We're very great partners with Inveniam as well as Tokeny and others on this webcast today. And really, what we do is we're all about RWA, primarily securities, on the blockchain, and what we provide is an end-to-end market solution, including trading.
Fantastic. Thank you, brother. Daniel, you're up.
So I'm Daniel Coeur from Tokeny. So I'm very pleased to be here with you again, Pat, today, and all the other participants. So I'm the co-founder and responsible for the business development of Tokeny. Tokeny is a company that has developed an on-chain operating system for financial institutions. So we've been in the business for 7 years now. We have developed the ERC 3643, which is a framework that enables to enforce control and compliance on digital securities. This is a framework that we have open sourced last year that is now carried by a nonprofit association, the ERC3643.org. It became an official standard of Ethereum in November last year, the sole official standard that enforces control and compliance. And we started to present this framework to regulators around the world to make this approved by default, so that we can start finally issuing digital securities on chain, natively on chain. So we're doing great progress, and recently we presented to the SEC as well. So other than that, Tokeny has been issuing more than 30 billion of assets on the blockchain, on public chain, EVM compatible, and we have more than 100 customers.
Fantastic, Daniel. It's great to be with you and have you join us. You guys are doing amazing work, and keep it up. And I think the 3643 work that you did originally and then open sourcing it has been a real benefit to the entire community. So great job, brother. David, you're up.
Yeah, sure. So Houlihan Lokey is a very large publicly traded investment bank. In some ways, we're the stepchild of this group because we're highly traditional, highly relationship based, but we have an eye towards where markets are headed. And as we develop a sort of our footprint inside all of these smaller firms, all of the middle market firms who are investing in them. We want to know where this is going, and we're starting to develop our own analysis and valuation approach around these assets, which are different than traditional assets. So we are we're valuing digital assets in a way that it can be consistent with the frameworks of traditional assets, because that's who our clients are, and reconciling those differences between traditional assets and digital assets is part of what I do and why I'm here.
Oh. I'm sorry, I've lost audio there for a second. David, did you? I hope the audience got that, and maybe it was just me who missed it. Okay, good. David, thank you so much, brother. Good to be with you. And one of the things, as we think about your market segment, David, we think particularly from Inveniam's standpoint, very much that market segment will be one of the early adopters in this space. And so where you live is where we think that market is going to go with those traditional players going online. They will be the early adopters in many ways. So with that, Kevin, thanks for joining us again. You want to give a quick introduction of yourself and then also kind of teeing up some thoughts about this call.
Sure. Kevin Cutterback, Chief Data Scientist at Inveniam. Very often I'm called in on DeFi questions about where data comes from, what chain is appropriate for processing, or where it gets processed. So I have questions for everybody all along sort of the value chain for managing risk. From what assets are we talking about? Where is their data? Which data do I need to find, to power my models? And then I think we'll save the whole question of now that I think I know I have what I need to understand the risk of something. How do I process it to really get my answer? And what do I do with my answers? How do I deploy my answers? How do I make money from my understanding of the risk, whether it's insurance or hedging or something else that our panel will tell us? So that, I kind of think that sort of the DeFi value chain is what we're going to talk about today. And I think that we have a great panel for just telling us what kind of assets are we talking about and what kind of risks are we hoping to understand when we talk about modeling risk in DeFi. And then, I think we'll look next at the data from those risky things.
Yeah, thank you. Albert, you're up as our final introduction. Thanks so much for being with us again. Why don't you give a quick introduction and any initial thoughts?
Sure. My name's Albert Verdellens. I lead the AI division at Inveniam. I also manage our relationships with large-scale tech companies. As a hobby, I'm an inventor. I've invented an alarm clock, patent pending, for our TradFi clients whose eyes glaze over when we say the word blockchain. And that is going to be a very interesting aspect that big data fans are going to have to get used to, is something's going to have to create the integrity for all that data that you use and maintain it over time. And that is going to be a very interesting topic for the future, but I digress. And Pat, I'll start with just kind of one question to tee us up. Just to clarify topic, are we talking about modeling risk and how that happens in DeFi, or are we talking about risk in DeFi and how to model it?
So great question. I was actually that's catching me unaware, and I like that question because I'm going to add a third one, which is where I was going to go. Because when I used to work at Bear Stearns, I used to I heard this is way back in the 90s, and I have parroted it since, that two people in a plane at 40,000 feet jump out of a plane, one with a parachute, one without a parachute. who has more risk. And the person with no parachute has no risk. Their outcome is certain, right? The person who wishes to achieve a certain outcome has the risk and is in the business of mitigating that risk to achieve the outcome that they're setting upon. And one of the things that we are not going to talk about, I don't think, is the risk of going into DeFi. Right? But rather, there's an assumption for those who are in DeFi who've said that DeFi is the next really marketplace and it's the next technological evolution. How do we understand risk? What are the risks of the assets that are in DeFi? And then I think your question, what are the systemic risks in DeFi, particularly around counterparty risk, and how do we model that? And so from my standpoint, it's a both and. And David, what I'd like to do is maybe tee this up to you, and then we'll go around the horn. And as you think about risk in DeFi, and you think about what that is, you've spent a career looking at risk. And how do those models translate over? And when you think about this, what are the risks that you're looking at?
So let me also kind of back up one second. When whether it is sort of a trader sitting at a trading desk in a bank, a traditional sort of centralized market, or whether it's an asset manager, their fundamental job is to take a dollar and buy something with it, go long, buy a thing typically. And when they do that, they have to evaluate primarily its price risk, and then the return that they get from taking that price risk. And so when I think about risk, I wanted to start with kind of, all right, what is risk? Risk is the volatility of that price, and the amount of return that I get on that volatility. That's that sort of traditional measurement. When you do that from an investor's perspective, then particularly from a trading desk perspective, where you've got a shorter medium hold period, you're going to look at that with a set of models that are very mathematically oriented, and those models will rely on really good quality data. They'll rely on, and a lot of times they're going to rely on a very large set of related assets, and that's this correlation concept. And actually, I'd love to hear everybody talk a little about correlation as we move through this discussion, because what happens most often is that there's a very deep set of data on a very small number of assets, and then you've got all these other assets that you think there are profit opportunities in, but you're not really sure, and you can model them, but in doing that modeling, that you'll determine what looks good, what looks valuable, but then you actually have to execute both into the investment and out of the investment. So I'm sort of lining that all up because there are risk components all the way along here. There's a risk element in the hold. There's a risk element in maintaining that investment, and there's a risk element in the execution and exit of that investment. And one of the things that I know that that you have to spend a lot of time with when your data set and your models are not specific is how the assets you want to work with correlate to the other highly liquid assets or highly observable assets. So it's a little bit of a long-winded answer that says the better the quality of the data, the breadth, the granularity, the more ability you have to observe the particular risk. You need to be able to follow it up with execution in that market in size, and a size that won't affect the market, so that you can count on it. But most markets are not that good. So to the extent that you have to look at correlations against other assets, you're going to run that same sort of popular methodology that it takes to take correlation risk as a subset of your risk. And when you do that, the whole data matrix kind of explodes and gets to be a much larger computational problem. My guess is that's what Inveniam is working with, is that large matrix of computational issues around all of the cross correlations. But as a risk manager or a risk observer, that's where I would tend to focus, is how do these assets work together? How do I get my best data sources to give me information about my worst data sources?
Pat, you're muted. Can you start that from the top?
Yeah, Eugenie, I think that's a tee up for you directly, brother. So why don't we go to you directly from there? You know, as you are in these markets, as you are trading, tell us how you think about risks and what are the risks. How are you managing that data? How are you correlating that data? How are you finding the data that you need to understand and quantify that risk? And how is that evolving? Where did it come from, and where is it going? And where is it today?
Yeah, absolutely. So everything that David has said is very, very relevant and absolutely true. If I take a step back from from this for a second, what is DeFi? DeFi is essentially a set of traditional markets taken, bundled together, repackaged with different branding, and deployed on new technological rails. So you have an interesting situation where all the, what they teach us in graduate trainings in investment banks and business schools, right? You have market risk, liquidity risk, counterparty risk, operational risk, credit risk, and a bunch of other things, right? So all of these things are relevant and apply because if, let's say, you want to trade an asset, whether you trade that asset on NASDAQ, on Binance, or on a DeFi protocol, I mean, you're buying an asset hoping it goes up, but it can go down, right? So the intentions are the same, and your job is identical, right? You source data. Just in that case, you have to source it from the blockchain, which is it's both easy and hard. It's easy because it's publicly available, so therefore there is no barrier. But it's hard because it's very specialized, very different, and you just need to build up that expertise. And you're competing against people who are doing it for a living and have been doing that for 10 years. But what I think is probably interesting or could be interesting to the audience here is DeFi introduces a new type of risk, which has never existed anywhere else in the world, and that's, to put it simply, software risk. Right. So when you're trading on
and that risk is meaningful, right? It is
exactly. Yeah. So we basically run a DeFi hedge fund, and 90% of our risk management effort goes on assessing, modeling, and managing DeFi smart contract risk. So if you are trading with the prime broker or again in traditional markets, you care about operational risk, but unless you're high frequency and algorithmic, you don't really kind of care, right? I mean, I used to work in a hedge fund, you run a long book, you have some stocks, you'll figure out how to sell them if you need to sell them, even if there is an outage on an exchange, right? Which obviously almost never happens. But in DeFi, you don't really worry that, your counterparty bank can get hacked. You worry about them having credit issues, but that's a different story, and there are ways how you can manage that. But if I'm a finance professional who goes into DeFi to deploy someone else's capital or my capital or do whatever, how do I analyze the code? So most analysts who work at my firm, these are the types of analysts who cannot read the balance sheet, but they can read a very long piece of code and they can tell you if it's safe or not safe. So what we end up doing, we actually published a paper on this a couple of years ago. We have aspired to standardize that risk. Because when we talk to investors and they say, well, DeFi is very dangerous, it's like, maybe I get hacked. Well, maybe. But you don't go into a lending business worrying someone can default on your loan. You understand that you're applying a portfolio approach. You're dealing with different types of counterparties. You assign the level of risk to each of them and you size them accordingly. So what we have been able to do, for example, is analyze by now probably more than 1,000 DeFi protocols. We have constructed a framework of different vectors of risk, because they're not just, someone can come and hack it. There are many vectors as to how that can play out. You construct that framework, that matrix. Then within that, because we've been around since day one of this industry, DeFi, we have a library of every single thing that has ever gone wrong. And we know how it could have been mitigated and how it should be mitigated. So on the back of that, we're able to construct basically like a checklist, and then someone gets a AAA, a BBB, and CCC, and through that you can have a very systematic approach to modeling and managing that risk.
Eugenie, I want to thank you for that, and I think this directly opens the door to Pat LaVecchia and what you're doing. because I think the DeFi protocols and what you're talking about right now is where these DeFi protocols are being used in conjunction with digital assets, chain, and for much of the other real world assets or alternatives where the data lives off chain and what's on chain is a zero knowledge proof that informs that. It informs a fund. It informs a something that is not just a floating point variable, meaning decimalization of a Bitcoin, but rather a series of variables that exist around the gross value of the asset, the waterfall, the carry calculation. How do you price the cap stack? What is the ownership stake of that? What's in that cap stack that I own, along with 20 other positions in a fund that rolls up, Pat, into something that you are going to lend to, or not lend to, that you're going to have trade on your marketplace, right? And as we think about that, tell me about when you think about DeFi, and you're on mute, so we want to make sure we capture your first comment. When you think about DeFi and listing these new private market assets on your exchange, to what degree is DeFi and this promise of additional liquidity a big part of the attraction of drawing people onto your platform? And how are your clients thinking about the risk, the counterparty risk, the execution risk, the stability of the system's risk?
Yeah, that's a great question. We're still in the early days, Pat, on all that. And by the way, David's comments, your comments, Evgenie's comments, I agree with all of them. We're, just as a bit of background, we're integrated with 16 blockchains and 4 bridges. So we've gone through that process, not only integration, but looking at the code, et cetera. And some of the bridges, I won't mention names, have been hacked. Some of these blockchains have been hacked, right? We've heard about that over the last several years. And I view DeFi and that software risk very similar to cyber. It's not going to go away. So I see those merging. What the cyber firms, the consulting firms, et cetera, and the software to monitor them, that they'll move into DeFi to give more credibility to that entire space. So in regards to trading, and as we discussed, the end-to-end market solutions that Oasis Pro provides, is that today it's about tokenization, getting real-world assets out in distribution. DeFi is, we all, I think on this particular panel, and most likely many of the participants today, expected DeFi to be a larger component of RWA 1 or 2 years ago. It's just been slow. But those first pieces I've just mentioned, tokenization and moving into primary issuance by a whole group of issuers, and we're still in POC world with many of the major financial institutions, despite the headlines that we see. Some are real, but for the most part, they're POC. That's the area of focus. The end game, or the short-term end game, is DeFi. And DeFi is collateralization of underlying assets. I'll give you an example. Utilizing DeFi protocols, there's Maker, there's Aave, et cetera. There's a whole, you have to go through an approval process. They have governance teams, et cetera. They have votes. But think about LP interests. Zombie LP interests. Zombie LP interests, that's not going to trade. That's not a real tradable market. And by zombie LP interests, I mean the life cycle of the fund in terms of investment is over. They are in harvesting mode and probably only have a couple of more investments. So a 7-year fund or 5-year investing fund, maybe in year 12. And the cost of monitoring that for asset managers is really high in comparison to the assets in those particular funds. Well, wouldn't it be really exciting. And we've been having these discussions. We actually built a whole platform for this with a major asset manager. And it's not ready for the overall market yet, but it's live, is to take these zombie LP interests and then offer a lending opportunity against them. So not trading, but collateralization. And that is a great component of where DeFi can come in. I think that's a year or two away. So to me, that's the most forward thinking of utilizing DeFi at this point in time. And it's really very difficult to liquidate assets. Now, David's comments earlier and your comments regarding where's the data coming from? How are we going to assess the correlation risk, et cetera? That's all very important in regards to determining value, and liquidity is a part of that. But that's where what we are seeing is DeFi will have an impact in the future. We hope it's in the near future, but that's what I call the short-term end game, is how do we utilize collateralization of these real-world assets? And DeFi is very well positioned for that.
Hey, Pat, could I just
please
jump in?
Yeah, please.
On both Pats, I just want to point out that Houlihan Lokey has just bought an entire business that does nothing but secondary market transactions in illiquid LP interests. So this economic driver, and Pat, Pat Amira, you had mentioned before private markets. So yes, Houlihan's a very significant business set is in the private markets rather than public markets. So in private markets, there is this big economic driver to find liquidity around assets which have been deployed, older funds, continuation vehicles. The number of and NAV lending, so by funds lending it, there are multiple ways that there's this economic push to get liquidity into this market, but they're difficult assets to lend against because of information, everything else. DeFi is the right solution for that. Collateralized by virtue of the contract is the right way for risk managers to consider taking on lending risks, so you can put liquidity into that market. And there's a huge economic driver. Pat, I hope it's less than a year, but I know that the economic impetus is there.
Yeah, I mean, just to frame that, Evercore, who's the market leader in this, said they did 460 billion of it, of the secondary trading of these types of interests, and they earn 300 to 600 basis points on every single one of those placements. Right, that is a very nice business. When you look at what Pat is building and what you're describing, David, together, that is going to drive 300 to 600 basis points to 100 basis points when the data solution is there and implemented, and collateralization, and people understand that, and there's a centralized marketplace, and from there the spreads are going to go down even more. And Pat LaVecchia, your comment about cybersecurity and software risk inside DeFi, for everybody who doesn't know, GM got hacked today, right? Every one of GM's 15,000 dealerships is down. They cards in on trade, they're down in a cyber attack with ransomware, and you just go, that is an epic attack that is the same thing that you're protecting against. But I also believe the same way that cybersecurity and software risk in DeFi is going to merge together, DeFi and real world assets in a tokenized manner is, if you don't engage with the crypto world, you're not accepting the networked promise of why it was created in the first place in real world assets, and not just creating a TradFi digital solution that's 5% more efficient. You want to get into this fully networked, distributed reality, and that's what opens the door. And Daniel, I'm going to have that turn over to you, right? As you talk about tokenization, as you talk about tokenizing funds, and as an operating system to service these assets that are going to plug into DeFi, that seek the benefit and the liquidity of DeFi, the trading posture of DeFi 24/7, 365 around the world, as you improve data, as you improve systems and operating capabilities, what is Tokeny doing, and where do you see the opportunity into the clients that you're bringing on, and you're acting as that operating system? You're on mute, Daniel.
So first, I think that there's an opportunity to upgrade your internet connection, Pat. So, well, obviously, Tokeny has been for the last 7 years focusing on indeed what we initially defined as being tokenization. But I think that as time goes by, we realize that tokenization is just a subset of what we do. At the end of the day, this is just the initial representation of an asset on chain. But you need more solution, more services around that to make this token highly performing, as quoting Pat. So you need a lot of solution and technology around that. So that's why we are defining ourselves as an operating system. What obviously is core to what we do is to build upon a standard, which is the ERC-3643. We spend a lot of time, at least 5 years, in building that standard, which is open source. So please feel free to use and abuse. But it was very important so that everyone focus on the right value creation and not on building or rebuilding a standard that will force us again to manage different silos. We already have enough silos with private chains. Ultimately, everything will converge to EVM, but for the moment, we are dealing with all those silos. So let's not focus on building another silos. So the ERC-3643, I think, is essential for DeFi because unlike other protocol or attempt to be protocol, it's not using wallet, it's using identity. Because obviously wallets have shortcomings. They are anonymous. If you lose them, then obviously it's very hard to recover your assets if there is a way to do that. And also regulators don't feel comfortable with working with wallets. They prefer to have identity that have been properly KYC'd. And if obviously you want to move into institutional DeFi, then you also need to have a mean to restrict access to specific assets based on the profile of investors. Obviously, that's why we have, qualified, accredited, etc., whatever definition of investors that are supposed to know what they're investing in. And you need to be capable of enforcing that on DeFi protocol as well. That's why we built a solution Connect DeFi that enabled to plug into the identity of those investors operating on DeFi protocol, make sure that they have the proper profile to deal with those assets. But if we come back to the notion of risk, one thing that is clear is that the reason why this standard exists is because you are not going to spend time auditing every single smart contract that you have to deal with, because that would be extremely cumbersome and impossible to do. So part of the reason of the ERC-3643 is to have a standard that is fully audited. And obviously you can use it because it's asset agnostic. You just change the variable of your issuance. But you don't have, you don't create risk on the smart contract itself. Actually, we started, as I mentioned earlier, presenting the framework to numbers of regulators. And 2 weeks ago, we had a meeting with the DFSA in Dubai. They were the first regulator asking us to review the smart contract audits. They were the first one to understand that the risk is in the smart contract itself. And the true risk is in the ownership of that smart contract, protecting the wallet that has access to that smart contract. And we spent about an hour going through the report and understanding what was the risk, where were the risks, what risk do we create by using the blockchain, and how can you address those risks? Because the regulator is not stupid. They know that there will be risk. The problem is not to have risk and how to address those risks, right? So when the standard is really built in order to make sure that, first of all, we don't recreate a smart contract every time we do an issuance. Secondly, that we have properly identified those risks, and that we have a way to remedy to those risks. And thirdly, is to allow indeed the industry to start building value proposition on the top of that standard and deliver the value that our customers are expecting.
The comment about FRSA is wonderful because the fact that they're doing that, and let's kind of pick that apart for people who are watching this podcast. Why would they look at that? I think the main reason they look at that is because they believe that real value will and it's not going to be in a walled garden that they can undo a trade instantaneously. Do you know what I mean? That it's on a network that is controlled, but rather it's going to be on a public network. And there are mechanisms for, forced transfers, etc. If there's a juridic action, but it's not at the whim of the transfer agent. And the reality is, when you believe that value will be transferred on chain, you start to care about, let me see the code for in kind of a walled garden that any transfer agent who's regulated can move anything to anywhere against the wishes of the asset owner. You don't really need to do that. And what you see is, what I take that as is, they're finally buying the end promise is a reality and becoming a reality. Do you know what I mean? Because some of the other regulators are still, they're not doing that spade work, that necessary diligence that the markets are going to go where we've all been saying it's going to go for a number of years. So from my standpoint, that's a great sign. Kevin, let me just, when we think about risk, we've had David talking about risk at the highest level. How as Eugenie, as a buyer, and then Daniel is manufacturing new product that's going to interface with all these protocols. How do we think about where the data is going to live, and how does that inform risk, and how do we need to think about, as a chief data scientist for Inveniam, how do we need to think about risk for all of these guys as we want to understand assets that may or may not be natively correlated because of lack of marketable information?
Whew. That's a big, I was going to try to, I mean, the first thing is, if it is decentralized finance, the data is going to be decentralized. I just don't think there's any way of getting away from that. And if these are smaller assets, individual real world assets instead of a whole REIT, they're going to be smaller. They're going to be farther apart. They're going to live at the edge, and their data is going to be at the edge. So I think I'm not going to get any pushback on that here. For me, what I've been wondering is, again, and the same thing with the counterparties. The counterparties are, often anonymous, or, that they are decentralized. They aren't coming through a single broker dealer. So I have a whole bunch of questions about each one of the risks that Yevgeny originally listed. Credit risk, counterparty risk, liquidity risk, market risk, all those different kind of risks and their different kind of data. Like, how do you know that you've found the right source for any of those? And I wanted to, since Daniel was on this question of the identity of security holders, I wanted to ask specifically the counterparty risk. What do we do to understand who is on the other side of these trades? And I was going to go to Yevgeny for that. What do you do in a world where people wanted to be anonymous or thought they would be anonymous as counterparties? What do you do for counterparty for sourcing information about counterparties?
Yeah, absolutely. When it comes to data, I guess there are kind of a few categories within that. So sometimes, especially if these are real world assets that have their representation in DeFi, then you can get some data about these assets from the issuer directly, and then you need to be able to trust either how they produce or provide you with the data. Then it's the data about what's the state of play on the blockchain, right? So what are the actual prices? What are the sizes? What is actually happening? That you get directly from blockchain. There are some third-party tools which by now are pretty great. We ended up building most of that in-house. So we built like a mini Bloomberg internally, because when we started, there was nothing. So we have confidence that we're getting the right data about the state of the world, because it comes directly from the smart contracts which we're connected into. But that's obviously a very big engineering effort to do that. There are third-party platforms like a Bloomberg, Bloomberg-like, that provide that for you. And then with regards to the counterparty, it's a very good question, because technically your counterparty, it could be someone's wallet, right? So it's maybe it's one of the people on this call, or it could be a smart contract. And then you're interacting with this kind of aggregated automation tool, but actually you've got no idea where the money is going to go on the other end. So when you're dealing with a direct counterparty, it's very easy. There are third-party solutions which are accepted as a standard in the industry. And if I have your address, I can run it through those databases. And what they do, the interesting thing about blockchain is that it's pseudonymous, meaning that if I see a wallet called 12345, I may not know it's you, but I can see its full history and its full behavior. Whilst in the traditional world, you give me, a one-page bank statement, it links your name to an account, but I've got no idea what your banking history is going back 25 years, right? So here we know the whole history and the behavior of the address without knowing who these are. So the accepted standard in the industry is running through specific compliance checks and understanding whether you've only interacted with clean or dirty wallets in the past. And then if, for example, I can see that there is a wallet called 12345, it's been funded from 5 different sources, all of them are classified as clean, then great. If I see that you have interacted with a smart contract that is sanctioned, that is very visible on the blockchain, and it means you're blacklisted. And even the way how we're set up, because we remove that operational risk altogether, if it's blacklisted, then even if I try to click the button and transact with you, I will be blocked. So that tooling exists. It's far from perfect, but it's kind of good enough to protect you from obvious situations. And when you deal with smart contracts, sometimes it's harder to understand. But if there is a smart contract and interacted with 1 million wallets, and if 9.9.
And you, Judy, I want to jump in on that. There is, how crypto, with BitMEX to start, and then Tether now, and all these with proof of reserves and liabilities, right? That was out there. You could see there, and a lot of kind of the early stake a bunch of assets with us, and then those assets are we don't know whether the yield is real or not, or am I going to get it back, and you don't know the counterparty. The interesting thing is, as you said, that tooling is there, and that's better than TradFi's capabilities. Do you know what I mean? You're trusting, you got much better granularity and control and proof of reserves and liabilities, and or blacklisting, and instead of trusting a compliance process.
So it's a great point, and I think it's very important to be precise there, because this point that you mentioned, I've seen a lot of people get very confused if they're not kind of market participants, right? So I would argue that as Celsius, Genesis, Binance, these are not DeFi businesses. These are not crypto businesses. These are traditional companies managed in a very traditional way that happen to service crypto industry as an asset class. The way how, leaving aside all the noise and all the drama, the way how a Coinbase or a Binance operate for their core business is not really different from a brokerage business. So therefore, it's a public/private company, doesn't matter. You have to trust the data they give you, because all visibility you have you need to trust the system, right? They produce a financial statement, someone audits it, regulator maybe verifies it, and you have to trust that the system hasn't misled you. And that's why FTX happened, right? Because it's a private company that was taking people's money. It wasn't really reporting what it's doing with the money. It's not a DeFi business is radically different. It's a piece of software that exists in the public domain. Anyone can read it and have full information on the state of play, assets, liabilities, and the mismatch, if any. So when you have to trust proof of reserve, you have to trust that the private company is using a smart tool to communicate the data to you, but you still need to trust the process. The whole point about DeFi is that you don't need to trust anyone. You can still lose all your money, don't get me wrong. You need to know what you're doing, but you don't need to trust that you're not being misled, because everything is out there and it's impossible to lie, because I can go and validate it.
That's a great point. Let me just take the opportunity to remind all of our viewers, if you have comments or questions that we will take if we have time at the end, please put them below in the chat box. So Pat LaVecchia, I know that Oasis Pro has opinions on this topic. So go ahead and chime in. What do you think?
Yeah, well, look, I agree with everything that has just been said. I would add that instantaneous settlement, removing that counterparty risk almost entirely, and I say almost because we know it's instantaneous, but there's still that chance, is a huge positive of DeFi and the utilization of blockchain in general. So yeah, I would just add instantaneous settlement. Where let's look at the equity markets. They're now at T+1, right? T+3 to T+1 in about 7 years, 6 years, which is quite amazing. Once you get to instantaneous, all that counterparty risk goes away. You don't care who's on the other side. Now, the issue that we're running into, and others on the trading side, is anonymity, right? And large traders, if we ever get to high frequency trading utilizing the blockchain, and we will, it's just a question of when, the ability to track wallets and accounts is problematic. And we've been told that today because these are illiquid markets. There's not a lot of trading today, right? So masking who's on the other side, and that in regards to that, the ability to track, trail, go down the trail and determine who it may be or may not be is an issue. So the benefits are amazing, but from a trading aspect, what we've heard from institutional investors is there's that concern of not being able to trade on an anonymous basis today.
Yeah. So I was always taught that my boss ultimately is the market. So I'd like to hear, Daniel, in a second from Tokeny on this, because I think that there's got an interesting perspective there, and I'm biased because I'm on their board. But Daniel, if you could tell us what risk management tactics or features that have been rolled out have been most effective in developing a level of comfort from investors in the DeFi space that meaningfully make a difference.
Well, I'm going to come back to the RC3643. As I said, this is using an identity smart contract. Just for the sake of clarity, an identity smart contract does not mean that we put information on investors on chain and that information is freely available. What you have is anonymous claim, and that's really what I think DeFi protocol need is a mechanism to validate information and make sure that, again, if you are eligible, well, first of all, who you are you a legit person, right? Are you eligible for that type of security, for that type of trade, and do that in an anonymous way. So on-chain ID is an anonymous claim solution based on KYC information that is being done by agent. It's a duality of claim related to the information that you have submitted, and claim that are related to who has been validated the information, and there's a temporality element as well. So I think that we cannot work in an anonymous way. That is not something that regulators will support. Already for them having a smart contract that operate by themselves is a stretch in terms of understanding and approving. I remember not that long ago we presented to the CSSF how automatic market making works, and they were asking us, but who bears responsibility? Well, no one. Whoa, that was a kind of a shocking moment. So I think that we need to bring that level of comfort to regulators, that you identify stakeholders, and that therefore if there's mismanipulation or simply understanding the risk that you're dealing with when you invest is essential. So I think that this is for us the most important thing is this, and we see a lot of demand in the market. And I'm sure that in a couple of weeks we'll be capable of sharing more information on that. But there is a number of initiatives that are planning to rely on chain IDs, a mechanism to enforce identity on chain. And by the way, we also see that there are solutions, because when you talk about privacy, a lot of people get concerned about privacy. We see a rapid evolution of technology in the market. Company like Zama, for example, that are entering with FMA, with this homomorphic encryption that allows to bring privacy on public chain. that will add this level of confidentiality that is required, but without compromising on the fact that you need at a certain point of time to need with whom you're dealing in order to enable to have everyone's bearing responsibility. So that's, I think, something that is really key, and we feel like the market is evolving lately, and there will be enough confidence in the coming month, I think, coming years, to allow those DeFi protocol to be put into action.
That's great, and obviously the proof is in the pudding. The success that's had speaks for itself. So congratulations on that. David, I'd love to hear from you about the security measures that Daniel just described, risk management, et cetera. Would the clients that you normally deal with feel comfortable or more comfortable after things like that, or what's the next step? What's the next wave?
Right. So I'm listening to my three colleagues here on this panel, and it occurs to me that when in this world that I sit in of private assets, we are far less liquid. There are far fewer transactions. So I'm going to divorce the idea of crypto trading for a second from the idea of moving private assets around, and whether we move it through Oasis Pro in a tokenized format, regardless of what we use, there's an implicit understanding that you need to know who you are selling the thing to, and most of the private assets, if I think of a private equity fund, they want to limit the amount of information about the assets in the fund or the value components. They want to limit that information, but they know they have to release it. So what I'm getting to is that rather than a liquid market where you're going to expose some identity structure or wallet structure of a whole bunch of counterparties, you're actually, in this case, as I think about it, really want to selectively permission. So the idea that we can use this same anonymous structure with enough information so that a GP who wants to sell an asset can conduct an auction or could conduct a semi-open market framework by permissioning the number of people and the kinds of information they see. What I think the market needs to build private asset, real world asset tokenization is the ability to individually permission around identities and identity of the assets that are being sold, so that you can limit, control the information about both sides, yet have enough scope in there that you're actually creating a market with discovery. And that, I don't know what those boundaries look like. I know that some of you guys are starting to think about how to do that. But I know that as we talk to some of our larger alternative asset management clients, they're buying technologies because they envision that to be the way that they're both going to get liquidity and new assets under management. But the idea that you're in private markets and you have to be able to identify your purchasers, permission and limit the amount of information, but create a big enough sphere that everybody thinks that they've got what they need to transact. That's the place that we need to get to, and some of these technologies are getting there, but the markets all have to cooperate to get us to where we need to be.
And Albert, if I could weigh in real quick, and we only have 8 minutes left and 7 minutes left, and Albert took over the hosting duties because of my internet connectivity issues. Daniel, sorry about that, brother, and everybody else who bore with that. But David, I would suggest two things to what you just said. Number one, a large part of what you're describing, is I would say a commercial for Inveniam. But two, this is fundamentally we've talked a lot about understanding your counterparty and identity. That's been a big risk we've talked about, right? We've talked about software risk, right, where we understand that. We haven't talked about asset level risk, right? And we haven't talked about understanding that because there's either two worlds that exist. Either it's an asset that we understand pretty perfectly, do you know what I mean? And the dividing line is not real gray. It's kind of black and white. We got good data or bad data, and there's not gradients of bad. Do you know what I mean? It is either this is data that the assets can trade or not. and then we have to perfect the data to just get it over enough to get there. And in many cases, we rely on the goodness of that data based on a brand name like Evercore, right? Okay, they put together a book. It took them 120 days. The diligence period is the long pole in the tent to get us there. And then we go trust the book that they gave us, and they run the auction. Do you know what I mean? Or whatever it might be. And how do we shorten that pole in the tent from 120 days to 1 day or less than a day? How do we take that line and have gradients about asset level data as one of the risks? But also, when you have a DeFi protocol that makes their largest loan to a motorcycle dealership in Lagos, Nigeria, and then the next day all of the inventory and the owner is gone, right? They knew who they were lending to. It was just a really dumb loan, right? You know what I mean? And then we just need to understand, how do we figure out these all these things as we go from asset to identity to software risk, right? As the three main ones, but there's others as well. And maybe, Albert, can you lead us on a speed round?
Yeah, sure. So unfortunately, we're approaching the end of our great conversation here. So if we could just go around and get some closing comments from anyone. I'm going to go ahead and start with Yevgeny, because he's the most unique out of us. He ignored the memo that it's blue shirts mandatory on this call. So we'll go ahead and give the middle of Hollywood Squares the first crack at it.
Thank you. Yeah, I have the blue screen in the background, so that kind of cancels it out. My final thoughts would be that whether just because we call it DeFi and it's novel technology, it doesn't remove the basic common sense risks. So if you're issuing out a loan to a company in emerging markets, then, well, guess what? I mean, ultimately that money is going to be in someone's bank account or in cash, and they're going to be using it for business purposes. And the risk you take is very traditional. In short, the crypto technology can be used for two things. You can use it to streamline your back office, right? So is it more advantageous to issue a loan through the blockchain and give it to a company in Africa? Well, maybe because you're saving on some back office costs, but the risks stay the same. Or you can say, well, I'm actually only issuing my loans on the blockchain where my margin call mechanism is automated. And then that's great, because you don't need to trust anyone. As long as the margin call works, then that's great. And then obviously there is limited utility. So DeFi doesn't remove all the common sense risks we've been trained to respect. And you can either use DeFi and crypto tech to cut your costs or to create new business cases, but risks don't go anywhere.
Thank you. Daniel, you're up next. Your closing comment.
Well, I think that the amount of involvement that we see in the last month, that for most of us are below the radar, because we don't see what's happening behind, the curtain of those large financial institutions. From time to time, we hear, BlackRock or Franklin Templeton doing stuff. But I think that behind that, there's this whole piping business of CSD, market infrastructure, et cetera, that needs to be ready for that, wave that is coming up. All I can say is that we travel around the world and meet with those custodians, with transfer agents. The amount of resources they're mobilizing to be capable of supporting this innovation and what it means behind in terms of service that will be delivered to their clients is ridiculous. So make no mistake, this is going to happen. Again, I was yesterday in Frankfurt at Token Future 24, and two large German asset managers, Union Investment and Vanek, said that the future will be tokenized. There's absolutely no doubt from their perspective. They already take for granted that there will be massive cost reduction to their benefit.
Yeah.
But now they are looking at how do we expand, innovation to support distribution to digital native, to allow the creation of new custom-made product. This is really what they're looking at now. So I think that in their mind, we are already there. We as providers, I can wait to see that happening and are preparing ourselves for that. But definitely, this is coming next.
Thank you. David Wagner, you're up. Your closing comment.
Yeah, so just very briefly, risk has price. All right, so you have to be able to price risk. You have to be able to add up the premiums that all of your risks represent, and make sure that you're not fooling yourself In terms of the price that you're paying for an asset, you have to make sure you have enough built into your spread or your gain that you're covering all of these risk premiums, because that is the only way that an investor with a portfolio is going to protect himself across lots of transactions. So price risk properly. It should get cheaper in this world, but price risk properly.
Well said. So, Pat LaVecchia, you have the final word before Mr. O'Meara sends us off.
All right, I'll keep this short. So we know all the benefits of DeFi blockchain, right? Faster payment, increased safety, lower costs, perfect data. There's a lot going on behind the scenes that Daniel referred to, but we've seen this before, right? And sometimes there's starts. Here in the U.S., the regulators seem to be moving. In the past, that cloud continued. Now that Ethereum is no longer under investigation, that's terrific, right? In regards to how the SEC is looking at it. But when we stop talking about the tech and have the opportunity to talk about the business models and the opportunity there, that's the vision. That's what we're focused on. The issue is timing. And right now, I think it's all about survival and companies going through this, building, putting wins on the board. But no doubt, it's a question of when, not if. And I just look forward to webcasts in the future, if I'm lucky enough to be invited, where we don't have to talk about the tech at all.
Great point. All right, Pat O'Meara, send us off.
Yeah. Well, first off, I want to thank everybody for coming. And I apologize for my internet connection. It's been great having all of you. And I think that when we think about risk in DeFi, we see all the same ways we've talked about risk in our traditional careers, denominated with different tools, with better information, with instantaneous access, with better mechanisms for proof of that data. And what we have to do is allow these traditional risk models and pricing of that risk to be brought into this with the intellectual rigor that it is in the traditional markets. Guys, it's been great to be with all of you. Thanks so much. We appreciate everybody who's attended this. God bless. Bye-bye.